Hi everyone, welcome to today's video. So let me start today's video on a slightly negative note by showing you the chart for Hindustan Unilever, how it performed after 2008 crisis. There is a very important lesson here. So let me take you to the chart right away. So if you see, this is where the 2008 financial crisis happened and the stock was roughly trading at around 220, 230. And it continued to trade at those levels up until for roughly 2 years. So for 2 years, a market leader like Hindustan Unilever did not give any return. Why? Because during that time, one of the key reasons that was cited for the poor performance of Hindustan Unilever and other FMCG company was high inflation. So let me show you some data here. So this is the entire chart and you will see 2008 here. So really high inflation, and this was also true in 1990 when Iraq invasion of Kuwait happened. Now also in 2022, the inflation is very high. So can we draw the conclusion that something like Hindustan Unilever is going to be a laggard stock? It is not going to give very high returns, at least for a foreseeable future. I will let you know the answer subsequently on the video, but a couple of points to note down is that right now the inflation is very high. Back in 2008 also, the inflation was very high. Number two, with the Ukraine-Russia crisis blowing up, the inflation is likely to become even higher. So that further adds fire to the fuel. Not a great sign. Number three, if you are tracking the fear index or the VIX, which indicates the volatility in the Indian market, then you will see that in the last 5 days, the VIX has been very high. And if you take a look at the VIX right now, it is peaking. It has made its recent high peak. So all these indicators are probably indicating that we should sell everything and go away from the market in a way. Should we be moving all our money to fixed deposit now? Let's understand this answer in a very easy to understand fashion. I will speak about the major instruments, my viewpoint on those instruments. Should you be investing? Should you not be investing? And what is personally my strategy when it comes to investing in these different asset classes. But before that, it is very important to do a macroeconomic expectation analysis. Now, I will speak about three very simple but very, very important points here because expectation setting is very important. I have been getting a lot of comments that Akshat, you have been wrong about like this stock, that stock. Folks, the market itself has been down by roughly 13-14%. That's the Indian markets, that's the US market. Bitcoin and crypto markets have also corrected. So if I'm investing in any particular asset, it is likely to go down because the entire economy is going down. All the investment classes are going down. Here, expectations of some of the audiences that Akshat recommends certain stock, and from tomorrow, irrespective of what happens in the market, the stock needs to give a run up. It doesn't work that way, and therefore understanding these expectations is very, very important. So I will break apart three specific points. So the first key thing is that the recovery should happen and it should start happening fairly soon. Can I guarantee that? Absolutely not. But short-term pain is there, but mid to long-term prospects look good because right now the markets are getting back to sensible valuations. So let me prove that point by taking you to a macro chart of Nifty 50. Now here what you will see is that this phase, right? This was mid of 2021 and we are almost at that level. So we are roughly 10 months back now, and this seems like a great support because market gave a run up from here to here. It consolidated, it went up a little bit, then consolidated, it went up. It has been consolidating and falling now. So it's not as if that the markets are overvalued. Now this can be judged from this number that in the last 5 years, the markets have only given 82.61% return as of today when I'm making the video. So the important point is that entire narrative that the markets are overvalued, this, that. Now the markets are not overvalued at all if you look at the absolute returns that the markets have given on a 5-year CAGR perspective. 82% return over a 5-year window is not even 13-14% CAGR per year. So just to conclude, the recovery should start happening very soon because markets are not overvalued at this juncture. Second key point, that what type of recovery we can expect. So essentially, this brings me back to that HUL example, and please listen to this part very, very carefully, that there have been two prominent recovery shapes that have taken place from 2008 onwards. In 2008, we had something like this type of a recovery, right? This is called a W recovery. Now, if the market falls down and it just goes back up, so this happened in 2020 COVID times. This is called as V-shape recovery. Now this W-shape recovery takes time, and that is precisely the reason why after 2008 crisis, it took markets 4 years to recover. That was a very elongated period, and therefore you saw Hindustan Unilever type of companies struggling and not giving returns for 2.5, 3 years. But what happened to HUL back in 2020? It fell from 2400 to approximately 1900, and there was a very sharp recovery. There was a V-shaped recovery of HUL also and Nifty also. But in 2008, the markets themselves took 4 years to recover. Now you'd say, Akshat, what's the guarantee that the markets will not do a W-shaped recovery this time around due to Ukraine-Russia crisis? Now I can't give guarantees per se. I can just do data analysis and present my viewpoint. So my viewpoint on this is twofold. Number one, that after 2008, the script for recovery has changed. For example, from 2008, the quantitative easing has started and governments are using QE as a major factor in terms of boosting the economy. So for every problem, print money, that is the simple solution. We have spoken about it on earlier videos also. So right now, the governments do that quite aggressively, and that is one of the reasons why 2020 also the markets did not fall too much. Second key reason, the Russia-Ukraine crisis is not as aggravated or extensive compared to something like 2020 COVID crash or 2008 financial crisis crash. Those were scary situations. World had not seen such situations before, neither 2008 neither 2020 COVID. But Ukraine-Russia type of geopolitical issues, the world has dealt with these type of issues much more frequently. So therefore, the market recovery this time around is also likely to be V-shaped or at least not languish for too much. So the word of the day today is languish. So let me know, what does that mean? Now here is one more bonus reason before I delve deeper into how you should take positions across different asset classes. Now the final reason is that in 2020, the big players, FII, DIIs, they lost a lot of money simply because of the fact that people panicked, withdrew a lot of money. Now when do people jump in? People jump in when the market start going up. That is the time that they will put their money. If you check the data during a crash, normal retail people, they withdraw their money. If they are not getting immediate returns, they will have a very hard time thinking about the markets even 5 days from now. The normal script for retail investors is that if I'm putting the money today or tomorrow, I should start seeing returns from day after. If I'm not seeing that, I'm going to pull out my money. And therefore, a lot of retail investors stop their SIPs. They just stop buying stocks, they just panic, they just shift all their money from stock markets to fixed deposits. Should you be doing it? The answer is absolutely not. You should not be doing it. You should not be panic selling. But retail investors do not unfortunately have that foresight, and they sell off their stuff whenever they start seeing little bit of red on their portfolio. The lesson of this story is very simple. See, FIIs and DIIs have to make money. There is no other way. When will they make money? They will make money when the markets are going up. Why? Because that is the only time when retail investors will start putting the money back. So they have all the incentive right now to take the markets up. And therefore, I feel that the markets are going to go up. If there is a specific video you would want me to make on this particular topic, I'll be happy to do it. So just comment below and I will definitely consider shooting that. Now comes the important question that Akshat, given this high volatility, interest rate and bunch of other negative things that are going on, what is it that we should be doing? Should we be taking more positions in stocks? And you yourself have started talking about Bitcoin. So should we not be investing in Bitcoin? All that stuff. So let us start having that discussion now. And here the fundamental principle is that whichever asset classes have fallen the most, please go and invest in this the most. Because if you buy things at the bottom and if you are able to successfully bottom fish, you are going to make the most return out of it. That's the first key thing. Second is that whichever assets that you are picking, you need to see fundamental value in it. Not me, not anyone else. This is your portfolio. So you need to see the fundamental value in whatever you are buying. So with these two specific viewpoints in mind, let us analyze some investment options and let me give you broad commentary on it. Let us start with Bitcoin, and if you check the price from the top, how much has Bitcoin fallen by? It has roughly fallen by 50%. Right now, it has started recovering a little bit. So it is back to around 45% loss from its top, but Bitcoin has fallen quite a lot. Now, I can't convince you whether Bitcoin has value or it does not have value. I have made separate videos on that, so you can go and check it. But one of the key reasons that many people do not consider taking positions in something like Bitcoin is that they will say that, you know what, A, cryptos have no value, B, and more importantly, they are not regulated, government will come, do bad stuff with crypto, and it anyways is a gandhi currency and all that stuff. So for those people who are shying away from making Bitcoin investments because they are not comfortable, the government is not approving it, this, that, here is an interesting idea for investment in Bitcoin. It is called as proxy investment. So what you can do is that you can purchase something called as Bitcoin Vest from Vested. It's a very easy investment option. So what you end up doing is that you end up investing in listed US stocks in companies that make money from trading of Bitcoin. So these would be companies like Coinbase, Similarly, you can invest in listed companies that are taking positions in Bitcoin publicly. These are again regulated by the US government and US exchanges. So very well regulated companies. Third, you can invest in mining companies that mine Bitcoin. Why am I talking about Bitcoin? Because Bitcoin is an indicator of what is happening in the crypto market. If Bitcoin is going up, it generally indicates that the crypto market is going up. If Bitcoin is going down, it generally indicates that the crypto market is going down. So Bitcoin is the alpha coin, and if you believe a little bit in the Bitcoin story or the crypto story, then Bitcoin, according to me, is likely to give the highest return. And a very easy way, even if you don't believe in Bitcoin narrative from a regulation perspective, that tax is high, I'll have to pay very high tax, it's not regulated, please go and invest in Bitcoin West. Very easy investment option, or directly buy stocks. So through this proxy ownership, you will be indirectly invested in Bitcoin. In case you want me to make a separate video of whether you should be investing in Bitcoin ETF or direct Bitcoin, or what are some of the other investment options around these West, let me know. I will make a separate video on that topic. So if you're investing in Bitcoin and the world scenario starts to improve, according to me, Bitcoin is likely to give very high return. Am I still investing in Bitcoin? 100% yes. I'm still investing in Bitcoin very, very regularly. Now, the second asset class in which you should be investing and in which I am also investing are stocks. And this includes both Indian stocks and US stocks. So what type of Indian stocks and US stocks you should be purchasing and why? So let us first very quickly understand the Nifty story. So from its peak, Nifty has fallen by roughly 13%, 13%. This is not a small fall at all. The markets have significantly corrected already. So now is a good time to start taking some positions and start strengthening those positions. This is great time to be making returns. Imagine it this way, do a thought exercise with yourself. Imagine if everything is going well in the economy after, let's say, 1.5 to 2 years. Then do you think that number one, we will reach back to the Nifty stop at roughly 18,600? The answer is yes. That will give you a gain of 14.5% because we are climbing from the bottom. Will the Nifty move even further from this? The answer is yes. It should definitely move further than this because the years of degrowth that is happening now, it will somewhat get compensated. So let me demonstrate this point by taking you back to that HUL example. So if you take a look at this period from 2008 to 2010, we made approximately zero return. But if you broaden the horizon, if you take a viewpoint of 2012, so in 2008, we were sitting at 250. So in 4 years, we made more than 100% return. Is it good? Is it bad? It is definitely good. It is definitely not at all bad. So you need to consider this viewpoint. There might be some dark phases, but whenever that bright time starts, the good stocks start moving at a very brisk pace. Now you can do the same exercise for the US stock market as well. So if you take a look at S&P 500, you can clearly see that the index has fallen by roughly 14.5, 15%. Not a small fall at all. So should you be investing in some US stocks? The answer again is absolutely yes. You should be investing in US stocks also. So let me do a very quick commentary as to what type of stocks you should be purchasing. So in India, I'm buying stocks that are debt free or almost debt free or do not have very high debt. And number two, these are cash rich companies that know how to grow profits. These would be companies like Hindustan Unilever. These would be companies like HDFC AMC. I know that I'm going to get a lot of hate when I take the name of that stock because it is not performing well as of now. But look at the operating profit margin of AMC companies. There is nothing off. It is just a bad phase that AMC industry is going through and there is nothing off with the stock from that perspective. Again, please do your due diligence and only then buy the stocks. But buy stocks that are debt free, their revenues are growing, they are making consistent profits. All these stocks will come back up. Please do not worry about that. In the US, what type of stocks you should be purchasing? I am buying stocks like Amazon or stable tech as of now. Have I stopped investing in something like Shopify or UiPath or Coinbase? The answer is no. It's not as if that I have lost faith on that stocks. It's just that these amazing companies like Amazon are available at a massive discount. So let me show that to you. So for example, if you check Amazon stock, it was down by roughly 26-27%. Now, if I'm getting that stock at a discount of 27-28% from its peak, then I'm putting my money right now here. It does not mean that I'm not going to take any positions on UiPath and other stocks that I've been talking about. I will keep on buying emerging techs, but majority of my US money for the time being will go to companies like Amazon. I might take even more positions after 1 quarter in emerging tech. For the time being, let's just wait and watch given the changed market dynamics, how these emerging techs are performing. Let us wait because there are so many discounted opportunities right now that we don't need to get super aggressive with our stock picks. But yes, in the crypto market, I'm still investing aggressively in a range of different instruments. Now comes the third investment option, which is bond. Now, bond market is something that I do not personally put my money in because I'm a slightly more aggressive investor. Everyone would have their own risk appetite. But having said this, I have put my parents' money in bonds. I see absolutely no problem in terms of investing in good bonds. Some important points to consider here would be that you would need to buy senior secured bonds. Please buy that and spread out your bond investments across different houses. Do not go and purchase bonds just from one company. That will be really bad. Another related point here would be that if you are a type of an investor who is just uncomfortable with volatility, please go and buy bonds. That is a good instrument for you. Equity market right now is very, very volatile, and in the short term it is likely to stay volatile. So please stay away from the equity market. Please do not expect that you are putting in your money in equity market right now. It will come back up and start hitting new highs from tomorrow itself. That is unlikely to happen unless you have a little bit of patience. Please stay in bonds. There is absolutely no problem there. Now comes a couple of more important questions that Akshat, I was reading about gold being a great investment instrument. Russia has purchased it. Ukraine has purchased it. Should I also go and buy gold? The answer is no. You should not be buying gold. If you take a look at the CAGR of gold over the last 10 years, it has been dismal 5.5–6%. Depending on which format you are buying gold, you might lose out commissions. You might struggle to store it. Bunch of different problems associated with gold. More importantly, you can't predict the gold prices. You might buy it today. Now it's making new highs and it might fall very, very badly in a few days. So it is not an investment instrument that majority of the young investors should consider. But yes, if you are a type of a person who wants to take little bit of exposure to gold from a wealth preservation point of view, it is completely fine. Please go and buy gold. No problem there. But don't expect to make magic returns from gold investing. So number one, we are likely to have a V-shaped recovery and the recovery phase should start hopefully very, very soon. I can be wrong, no doubt about that. Number two, if you buy fundamentally good assets, now you decide whatever fundamentally good assets are. According to me, it would be something like Bitcoin, which has fallen quite a lot. I see value in it and I'm willing to put my money in it and I see it making the most returns for me in the upcoming time. So I'm an investor there. Second, equity markets are going to be volatile, but it is also going to be very rewarding simply because of the fact that the markets are not overvalued anymore as per my understanding. Third and finally, if you don't like volatility, then consider taking positions in asset classes like bonds and gold. That should also be okay, but prefer bond investing over gold investing given its historic returns. I hope you enjoyed the video. Press the like button and I will see you tomorrow.